Welcome once again to this unit Money and Banking. This is video 2 of this unit. Just a quick recap of what we did in video 1. We tried to discuss the objectives of this unit, and then we went on to talk briefly about barter system, and then we discussed the functions of money, and through the functions we tried to define what money is. I think that's where we stopped. Today we will continue with this unit, Money and Banking. I just want to prepare you that you will find many new terms in this video. I want you to listen and understand carefully and revisit them so that you can consolidate your understanding. Now let us go to the next slide here. Now we will start with forms of money. Now you might be wondering, money is money, and what can be the forms of money? Here you are seeing that money can be classified as into different forms. Here first is fiat money and fiduciary money. Second one is full-bodied money and credit money. We will try to understand each term properly and then understand what is the distinction between these several forms of money. Okay, so now I am trying to show you what is fiat money. If you know the literal meaning of what is fiat, fiat means the meaning is order. Okay, a decree, D-E-C-R-E-E, decree or an order. Now who orders? The government. So if you read what is fiat money gets its value from a government order, that is fiat. If you see the image here, a 100 rupee note is displayed here. See all the currency notes that we use now. It is a legal tender, which means it is authorized by the government of India that it has to be accepted as a medium of exchange. So it is, the key point here is it is a government order. Okay, and that's why it acts as a legal tender, which requires all people and firms within the country to accept it as a means of payment. So nobody can reject. It has to be accepted. Such money is called fiat money. So unlike commodity money, fiat money is not backed by any physical commodity. Commodity money means any money which is made of particular commodity, like for example coins. Coins is or any other like say any commodity, rice and wheat can also be used as a medium of exchange. But unlike such kind of money, fiat money is not backed by any commodity, physical commodity, like say some metal or some other grain. Okay, its intrinsic value is significantly lower. What is the meaning of intrinsic value? Its inherent value, its innate value. For example, take a currency note here. What is it made of? It is made of paper. In fact, when currency was demonetized, one fine day, 500 rupees and 1000 rupee notes, what happened immediately? Those two denominations became just a piece of paper, which means the intrinsic value, the inherently this currency does not have any value. Where is it getting value from? It is getting the value from the relationship between supply and demand. Okay, of course, government prints say the number 100 on this and says that its value is 100 rupees, and its value of course is determined by supply and demand. So intrinsic value is much lower, very insignificant. It is just a piece of paper. It is getting a value only because of government's fiat or government order. In fact, most modern economies are based on fiat money system. So whichever economy you see, it is based on this fiat money system only, wherein some currency is printed on a piece of paper or maybe plastic currency, and then government orders that it has to be used as a medium of exchange. So this is fiat money. Now let us go to the next term, which is fiduciary money. If you see here, there is a check here. What is fiduciary money? Now it is not ordered by government. It is not a mandatory thing that one has to accept this money. It is only based on the trust between the payer and the payee. Two people are engaged in a transaction. It is a trust between these two people that makes this money valuable. So fiduciary money depends on it for its value on the confidence that it will be generally accepted as a medium of exchange. For example, check here. Check is not a mandatory thing that one has to accept, but when somebody is transacting through check, it is a trust between these two people that the check it can be encashed. Okay, unlike fiat money, it is not declared legal. It is not declared legal tender. You should take note of this. It is not a legal tender, which means people are not required by law to accept it as a means of payment. You can, if you offer check to any shopkeeper, he can reject it also. He says he doesn't want to accept check. He might ask you to pay in cash. It is perfectly acceptable. But if there is a good trust factor which is there between payer and payee, this check can be used for transaction. So such money is called fiduciary money. Instead, the issuer of fiduciary money promises to exchange it back for a commodity or fiat money if requested by the bearer. So if you are giving that check to somebody, okay, the person who is giving the check, he can say that he can take it back if requested by the bearer. Okay, as long as people are confident that this promise will not be broken, they can use fiduciary money just like regular fiat or commodity money. In fact, if you see in reality, we use checks as if they are cash, because that intrinsic, that inherent trust is there in the system. Okay, when in fact, even many of you might be paying school fee or any other payment, like say rent for your house that you are staying. All these happens in the form of checks. So which means there is a trust factor between payer and payee, and it is almost accepted as a cash payment only. So examples of fiduciary money include checks or drafts. Okay, so till now we discussed about fiat money. Now let us go to the third form of money, which is full-bodied money. Now what is full-bodied money? Full-bodied money is money whose value as a commodity for non-monetary purposes is as great as, which means it is equal to its value as money. For example, in olden days, kings, they used to mint coins of gold and silver. Now, if they say if they mint one on the coin, on gold coin, for example, it means 1 rupee. It means that the uh, the gold that the coin is made of, the value of that gold is equal to one rupee. Okay, which means the commodity value and the money value is the same. Now, when you take a currency note, for example, 100 rupees, if government does not order it, it is just a paper, which means the commodity value and money value are not equal. But in full-bodied money, the say coins, especially in case of coins, you know, if you give a silver coin of say 100, if it is minted as 100 on that, it means that that coin has 100 rupees worth of silver or 100 rupees worth of gold. So that is called full-bodied money. You just have to understand that in full-bodied money, commodity value, which means the commodity, the metal with which that coin is made, the value of that metal is equal to the number that is printed on that, the money value of that coin. Okay, so that is called full-bodied money. The last term that we will discuss here is credit money. What is credit money? It is that money whose value of money is greater than commodity value of money. Like, for example, nowadays we are not using silver or gold coins. Our coins are made of nickel or some other metal, copper. Now, when they say when they mint 10 on a copper coin, the value of copper, the copper with which the coin is made must be much lesser than 10 rupees that is printed on it. Okay, so the money value is here, the money value or the number that is printed on that coin is much greater than its commodity value, the intrinsic value. Okay, so in full-bodied money, the commodity value is equal to the money value, whereas in credit money, the metal or the material with which a coin is made or money is made, it doesn't have much value. its intrinsic value is much lesser than the money value. So examples, take token coins and promissory notes are part of credit money. Okay, all your currency notes, they are all credit money. So token coins, bank deposits, okay, promissory notes issued by central banks, all these are examples of credit money. So we discussed fiat money, fiduciary money, full-bodied money and credit money. In fact, these are worth knowing. These are not as part of your CBSE syllabus, but it is always important for you to know different forms of money. Now, after understanding different forms of money, now we will go to a very important concept from exam point of view also, and the core of this chapter also, which is money supply. So what does money supply mean? First, let us understand the definition of money supply. Now, if you read the definition, the total stock of money, you look at this word stock. Stock means, if you in the first unit when we do it in macroeconomics, we'll come across two concepts called stock and flow. So then we will discuss in detail, but for now you understand that stock means anything which is measured at a particular point of time, at a fixed point of time. That is called stock concept. Okay, so money supply means the total stock of money circulating in an economy is the money supply. Okay, the circulating money involves, now what is money? It is currency, printed notes, money in the deposit accounts, and in the form of other liquid assets. All these comes as part of money. Now, in most of your textbooks, this definition would be given. Money supply refers to the total volume of money held by public. It is very important. Okay, held by public at a particular point of time. That's why I am saying it is a money supply is a stock concept. Okay, held by public. Why we are mentioning or emphasizing on public here? Public is the one who demands money. They are not suppliers of money. They are the ones who demand money. So money supply, we are including money in the definition of money supply. We are including only those entities which demand money, not those who supply money. So most often this definition is asked. What is money supply? So you can actually write this definition. Money supply refers to the total volume of money held by public at a particular point of time in an economy. Now with this understanding of the definition, we will proceed now to how this money supply is measured. Okay, this money supply is measured using different measures, which is M0, M1, M2, M3 and M4. You need not worry about all these measures. Just for your information, I have put it here. We are only concerned with M1 money supply. Only this money supply, M1. Okay. So as part of your syllabus, we have M1 money supply. We will look in detail what this M1 money supply is. Okay. The measure of money supply is M1. So now, when can we say, now actually M1 is a very narrow and very basic measure of money supply in the economy. Okay, it is also called as narrow concept of money supply, narrow measure of money supply. If you look here, you remember this. M1 is C plus DD plus OD. Now what, if you remember, generally this is asked. What are the components of money supply? Explain the components of money supply is a very classic question asked. M1, you just remember this, M1 equal to C plus DD plus OD. Now, what does C stand for? C stands for currency held by public. Now, what is currency? Coins and paper notes. At any point of time in the economy, what is the volume of coins and paper notes held by public, by people? That is the first component. Now, what is the second component? DD. DD stands for demand deposits. Okay, demand deposits of people with the commercial banks. Now there are a lot of banks in the system. Now in all these banks, people like you and me would have invested our demand, would have parked our money in the form of demand deposits. Okay, so all this also is part of money supply. We will discuss what exactly is demand deposit in the subsequent slide. Okay. Now, what is the third component here? OD. OD stands for other deposits. Now, what are these other deposits? Now, this includes again demand deposits with RBI, just like commercial banks are for the public, RBI is for all banks. So, RBI is a banker for the banks. For all the banks, RBI is the banker. Like how for us, all the commercial banks are banks for us, RBI is the banks for all banks. Okay. So, even with RBI, many public institutions like NABARD, like say IDBI or any other public institutions, they have demand deposits with RBI. That also comes under money supply. Now, other element under other deposits is foreign governments and foreign central banks. Okay, just like RBI in India, other countries also have their central banks. They also park their funds, park their money with our central bank, which is RBI, in the form of demand deposits. Okay, that also comes under money supply. What's the third element under other deposits? International financial institutions like IMF and World Bank, many other international financial institutions, they have their demand deposits with our RBI. That also is part of money supply. So in all this, what you have to notice is that all these are demand deposits. Okay. Now, just this is a very important slide for you to focus on. This is the most important component of this unit of this chapter. Okay. So C plus DD plus OD. You have to remember this. Now, I don't know how many of you are comfortable or confident of what exactly is demand deposit. So we will just look into what exactly is demand deposit. Now, I just wanted to show you this slide, types of deposits. We have demand deposits and time deposits. Demand deposits are current account deposits and saving accounts deposit. It is like demand deposits are almost like money, cash. Okay. Time deposits are recurring deposits and fixed deposits, which means they are parked for a certain period of time. For example, if you go to a bank and invest your 1 lakh rupees or something like that in a fixed deposit for 5 years, which means for 5 years till it attains maturity, you cannot withdraw it. Whereas in demand deposit, it is as liquid as cash. Okay. So this is just for your understanding what are the different types of deposits. Now we will try to distinguish between, just for your understanding, for you to know what exactly is a deposit, a demand deposit. I have put up this slide. We'll just quickly run through this. What are demand deposits? Demand deposits are those deposits which can be withdrawn by the depositor at any time. Okay, it is like having cash in your hand, almost like that. It is very liquid. What is the meaning of liquidity? It is like you can use that for your transaction anytime. So they are as good as cash. Whereas time deposits have a fixed term maturity. That is, these can be withdrawn after the expiry of the deposit period. Like how I told you just now, if you invest your money for about 5 years in a fixed deposit, you can only use it after the term of 5 years expires. Before that, of course you can withdraw, but they are not as liquid. Okay, bank paid no interest on such deposits. Whereas in time deposits, you earn interest. Why are you parking your funds for 5 years? Because it generates interest for you. Okay. Demand deposits are checkable deposits, which means you can write a check on those deposits and you can withdraw cash. Whereas time deposits are not checkable. Okay, for fixed deposits, you cannot write a check and then withdraw money from that deposit. Okay. Current account and saving account deposits are examples, like how we saw in the previous slide. These are the saving accounts and current examples of demand deposits. Fixed deposit and recurring deposits are example of time deposits. In fact, time deposits are nothing but term deposits. For a fixed term, they are fixed, which means you cannot withdraw them as and when you want and use it like cash. As simple as that. Demand deposits are highly liquid. Liquid means it is like almost close to cash. Time deposits are less liquid due to term maturity. So you have to wait for maturity when it comes to time deposits. So I wanted you to have good clarity of what exactly is demand deposit, and hence I have shown you this slide. So when you look at the definition of or components of money supply, everywhere we are seeing this term demand deposits. Okay, demand deposits because it is highly liquid form of deposit. Okay, so M1 money supply is a narrow definition of money supply, and it indicates what is the liquidity in the system, how much money is circulating in the system which can be used like cash. That is the broadly the definition of M1 money supply. Now, I think we have covered quite a bit in this video. Now, just a recap, please work on these class tasks. That is, you can revisit the video lesson once again and read the definitions of different forms of money and write in your journal. Many of your Sandeep Garg book might not be having this, but I felt it is worth knowing these definitions. And of course, second one is define money supply and M1 measurement of money supply. You can also take note of the components of money supply. You can read your resource book once again and consolidate your understanding. Okay, so we will meet you in the I will meet you in the next video. So this is the end of video 2. Thank you.